Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today is an interesting day. We have had quite an amount of volatility in the markets, while some others are basically just moving flat. And we'll be trying to look into that, understand what's currently driving the markets. We also look at the economic calendar, and once we do, we also look at the technical analysis for major pairs. We look at the technical chart patterns for gold as well as oil. And once we do, we also focus on US and European equity indices. So hello, Joseph. Hello, Tapsked. Thank you guys for joining the session. Let's get things started. So I'll be starting with the economic calendar to try and understand what are the key developments that have happened in the global scene since morning. So clearly, we didn't have much happening. So since last night's crude oil inventories came in weaker than expected, we also had a sequence of data from Asia, that is Australia, China, and Japan. So for Australia, it was a good trade balance improvement. For China, it's the trade balance really improving. Then for Japan, we had the leading indicators index showing some good improvement. So we had the unemployment rate in Switzerland remaining the same. Then we had German industrial production data showing a contraction, though an improvement from the previous number. Halifax housing price index are slowing down in the UK, but coming in better than expected. Then from the Euro side, we had the French trade balance, Italian, and final unemployment change for the entire Eurozone coming in at 0.2% quarterly. This was a slowdown from the previous 0.3%. We had retail sales, which came from Italy, an improvement to 0.4%. Then the revised GDP for the Eurozone coming in at negative 0.1%. Which is a signal which may imply that if this keeps happening, then we could be seeing the entire Euro area being in a recession environment. So most important news for the day has been the unemployment claims. So unemployment claims came in at 220K, and this was a slightly higher than the previous reading of 219K, but also missing expectation by just 1,000. So this is largely very close to the expectation. So we had Canadian building permits increasing by 2.3% in the month of November. And this was a huge improvement from the previous drop of negative 6.5%. So in the US, we also had the challenger job cuts, which came in at negative 40.8%, a huge difference from the previous reading of 8.8%. So this is a change in the number of job cuts announced by employers, meaning that more and more American firms are cutting jobs. And by doing this, it basically means that the economy is weak. So firms only cut jobs when they're trying to survive. So in this case, it shows some softening job market conditions, which might be a leading indicator of the big number that we will be expecting tomorrow, which is the non-farm payroll employment change. And these will be happening at 4:30 p.m. So investors are largely expecting 185K, which is the consensus estimate. So the previous number was 150K. So if we see a bigger number of non-farm employment change, that would show some form of resilience in the labor market. But then if the number is lower than the expected 185K, it would mean that employment trends are softening, meaning that they are consistent with the Fed's expectations. And in this case, we might continue seeing a much weaker dollar compared to other currencies. So as we head into Friday, which is the last day of the week, we will be having a fresh number of Japanese economic news. So there will be the average cash earnings, which is the rate of wage growth, which is expected to have improved to 1% from the previous reading of 0.6%. So we also be looking at household spending, which is expected to have decreased to by negative 2.9% from the previous decrease of negative 2.8%. So we will also be looking at the bank lending year over year, which is expected to remain the same at 2.8%. So the current account, which is the difference between exports and imports, is expected to slow down to 1.85 trillion from the previous reading of 2.01 trillion. So final GDP price index is expected to remain the same at 5.1%, while final GDP quarter over quarter is expected to show an economic contraction of negative 0.5%. So economic watchers' sentiment for Japan is expected to slow down 49.0 from the previous reading of 49.5. So this is quite a wild number of Japanese economic news that will start from 2:30, and the last data point will be announced at 8 a.m. And there's a good likelihood that this sequence of Japanese economic news will cause some volatility for the Japanese yen. So if you are a night owl, then you might enjoy trading from 2:30 a.m., 2:50 through to 8 a.m. And this is mainly for the Japanese yen pairs. So besides this, we have had a couple of news currently impacting the markets. So one of them is the Challenger job cuts. So US-based employers announced plans to cut 45,000 jobs in November 2023, which is higher than the 36,836 in October. So the retail sector announced the most cuts, 6548, followed by tech, financial, transportation, as well as healthcare products. So while it was the first time since July that the announced cuts were lower than the corresponding month a year ago, the year-to-date tally of 686,860 jobs was the highest since 2020. So we are seeing a record number of job cuts happening in the US economy, and this is quite challenging. So if there's more job cuts and higher unemployment, then it may imply that the Fed has already hit its goals. And in this case, the bets on a March rate cut become increasingly stronger. And in that case, we might continue seeing a much weaker US dollar. So on other news, the S&P 500 added about 0.5%, and the Nasdaq gained about 0.9% on Thursday. This is today, led by an over 5% surge in Alphabet shares after the release of its most advanced artificial intelligence model. So Apple, Amazon, Nvidia, and Meta are also more than 1% higher, and AMD soared more than 5% after Meta, OpenAI, and Microsoft said that they will use AMD's newest AI chip. Meanwhile, the Dow Jones traded around the flat line, with traders awaiting the jobs report tomorrow for an ultimate update on the US labor market. Figures today showed initial jobless claims rose slightly, less than expected, and continuing claims fell more than forecast, while the Challenger report showed companies cut more jobs in November. So I think that's a pretty comprehensive overview of what's currently happening in the markets. Of course, we have the big news in oil. So oil edges up after steep losses, but weak economic outlook lingers. So oil prices rose on Thursday. This was earlier in the day, a day after tumbling to a 6-month low, but remained under pressure as investors worried about sluggish demand in the United States and China. So Brent crude futures were up 32 cents or 0.4%, and this was in earlier trading before raising gains. So with the largest global oil importer, China, shattering its thirst for crude, pressure remains on prices as the largest producer. The United States continues with headline output. So clearly, after investors bet a lot on the resurgence of China, especially after removing COVID-19 restrictions earlier in the year, what we saw is the Chinese resurgence failing. The way we were expecting the Chinese economy to bounce back did not happen. So as a result of that, demand for oil from China has significantly gone down. So while on one side, the OPEC Plus nations have been cutting their oil output, the US has been taking advantage of this by increasing its own output. So the world's largest oil producer, which is the United States, have been basically expanding its output. And as a result, we have been seeing much lower oil prices. So on Wednesday, the market was spooked by data showing US output remains near record highs, even though inventories fell. So US gasoline stocks rose by 5.4 million barrels last week to 223.6 million barrels. Energy Information Administration data showed more than quintuple the 1 million barrel build that had been expected. Concerns about China's economy also put a lead on oil's price gains. So Chinese customs data showed that crude oil imports in November fell 9% from a year earlier, as high inventory levels, weak economic indicators, and slowing orders from independent refiners weakened demand. While China's total imports dropped on a monthly basis, exports grew in November for the first time in 6 months, suggesting an uptick in global trade flows may be helping the manufacturing sector. So, ratings agency Moody's put Hong Kong, Macau, and many of China's state-owned companies and banks on downgrade warnings on Wednesday, a day after it put a downgrade warning on China's sovereign credit rating. So this is quite a challenge when you see the Moody's downgrading Chinese companies as well as Chinese sovereign bonds. So in this case, we are seeing cracks happening in the Chinese economy, which is not a very good outlook for oil prices. So oil prices have fallen about 10% since the OPEC Plus, the Organization of the Petroleum Exporting Countries, and allies announced a combined 2.2 million barrels per day in voluntary output cuts for the first quarter of next year. The market seems to be suggesting that they don't believe OPEC Plus has the ability to follow through on their cuts, said Phil Flynn, an analyst at Price Futures Group in Chicago. So Saudi Arabia and Russia, the two biggest oil exporters, on Thursday, called for all OPEC Plus members to join an agreement on output cuts for the good of the global economy. Russian President Vladimir Putin and Saudi Crown Prince Mohammed bin Salman met on Wednesday to discuss further oil price cooperation, while OPEC Plus member Nigeria said it would not rule out extending or deepening oil supply cuts. So it's been a roller coaster week for oil traders, and what we have been seeing as a result of that is increased volatility, where we are seeing oil dumping down even with bigger gaps. So from the high that we saw a week ago of $84.466 per barrel, we later on saw a big sell-off that has continued through to this week. And of course, today's early morning gap has continued to show. So what we are seeing here is a big sell-off in Brent oil prices. So right from the opening of the day or the closing of last night to the current price, we are down 6.24%, and the price has just broken the previous support. So the daily low for today was somewhere around here, $74.217 per barrel. But then the current candlestick, and this is the 15-minute chart, is showing a clean break. And if we happen to cross here, then it's an indication that we could be headed for much lower oil prices. So remember, this is a 6-month low. So if you go to the daily chart, you'll notice that the last time oil prices were trading at this level was on the 29th of June earlier this year. So in this case, we're expecting to see some further downside momentum. And of course, the lowest price we have seen in oil is somewhere around here. And this was around $70 per barrel. So in this case, looking at the better part of the year, since January last year, January this year, there was a big spike, especially after Russia invaded Ukraine. And this is last year. So from here, we've had this bearish momentum. We found some support here. Oil rallied to $94.87 per barrel, and now is headed back lower and is set to close the year near the yearly low. In this case, these are out of indications indicating some further bearish momentum. And to sum up the factors, I would say on one side, we have weakening demand from China. So when you see the Chinese economy being pretty weak and being downgraded by the Moody's, then there is cracks everywhere, and it means that there is a lesser outlook for oil. So on the other hand, the US producing excess oil, which is basically matching the oil output cut by the OPEC, is leading to an excess supply of oil in the markets, and this is leading to even lower prices. So the third and most important factor is the potential for Saudi Arabia engaging in an oil market share war. So while Saudi Arabia and OPEC Plus nations have been cutting their oil output to manipulate prices higher, the US has been getting a bigger market share together with other non-OPEC countries. And in order to fight these, Saudi Arabia is rumored to be preparing to flood the market with oil supply, which would drive prices lower. And this is something that we already know and understand because it happened in April 2022. So sorry, not 2022, but 2020. So this is 3 years ago. So here we can see how oil prices are largely plummeted from around $71 per barrel all the way down to $19.412 per barrel. So in this case, we will be expecting to see some further downside. So as per support and resistance levels, we know that the next available support is around $71.9 per barrel. So in this case, if we continue seeing some further downside momentum in Brent oil prices, then the target becomes 71.9 as a take profit for any short sellers. So as for gold, what we saw on the market open on Monday was a big spike all the way up, and then market raising all the gains after trading above 2180, and then getting to a low of around 2021 before closing the day higher at around 2029. So since then, what we are seeing in the markets was this bounce off strongly and getting a top of at 2041. Then the market forming this bearish momentum chart, finding a double bottom. I remember analyzing this bottom early in the morning session. This was during the market snapshot series, and we mentioned that once the market has broken this neckline, after forming this double bottom, we were expecting a good rally all the way up to 2039. So eventually, the market rallied, pulled back for a while, and then continued and eventually hit our target of 2039. So upon hitting that target, you can see the resultant price action, which basically means that prices now headed down lower, and now we have already tested the low of the week, and this is the low that we saw on Monday. So this is around 2020. The market is just bouncing off the 2020 price level. It has not broken yet. So this means that there's a good chance or likelihood that the market could rally back upwards and potentially get to the previous bottom. And this is the area where we had the bottom for the double bottom formation. So this is our double bottom for earlier in the day. It has been found as support and then broken, and now it's a resistance. So if the price was to bounce from this area of 2020, I expect a rally all the way up to 2025.14. So the buyers is still bearish. We are still seeing, yes, this is a sideways momentum for the last 2 days. But then at some point, I expect to see some form of breakout. So if oil prices don't rally and break this, then the sentiment remains bearish. So as for now, a strong bounce from this area is expected to rally and at least get us back to 2025.14 price level. So the dollar index seems to be pretty weak today. So we have had quite a good number of days where the dollar index was pretty strong. This is 6 straight days. And now for the first day in 7, we are seeing the market taking a step backwards. So from the list of economic data, especially the jobs market data, which is basically indicating a softening of the job market, what we are seeing is the dollar index taking a step back. And as investors bet on a potential rate cut in early March next year, then we could be seeing the dollar index continuing to take a step backwards. And of course, if you notice clearly, this was a previous resistance point, which the dollar index was unable to break and is now headed back downwards. And with a weak dollar index, then you can see the big burst of momentum downwards. So I remember in the morning during the snapshot, we discussed the USD JPY currency pair, and we saw a potential for the market dropping all the way down to the yellow zone, which was hit in the current hour at 144.420. So some further downside momentum is already showing signs. So you can see signs of the market clean breaking this area. And if there's further downside momentum, then we look for even lower prices. So as for now, I'll be observing the area as more of a focus point where the market could potentially retest here or even move higher. But then there's that potential that the market will at least retest for 144.420. So once it retests, then we observe the price action if there is more momentum higher, or whether this becomes a stumbling block and a basis for some form of consolidation before we move lower. So for pound USD, we are seeing the pound making an interesting bounce from this area here. So after getting into this falling wedge, we have had the market finding a very strong support here. And then you can see after making a rally in early morning hours, we have seen the market pulling back downwards, getting some support again from here. And now we might be headed higher. Of course, the new target now becomes the previous high around 1.26048. And if we break here, then we head for 1.26363. So for Euro USD, we are seeing a strong bounce. I remember in the morning during the market snapshot, mentioning that this sequence of candlesticks is indicative of a strong bullish entry. And as we have seen over the preceding hours, is that the market has remained resilient and is now due for a rally. And the rally is expected to extend to 1.08280. So I expect the price to at least jump and get to this area before moving higher as the dollar weakens. So with the weak dollar, which has been strengthening against the Canadian dollar, in this case, we have a little bit of a difference in momentum where the Canadian dollar is strongly correlated with oil prices. So while oil prices continue weakening, also the Canadian dollar keeps on weakening. And after breaking this particular trend line, then there is that potential that the dollar keeps on rising against the CAD and eventually gets to this level of 1.36537. So as for gold, I think it's moving too fast for me. Just talked about this a couple of minutes ago. So 3-4 minutes ago, and now we have a strong rally and the market is almost hitting the target. So for those who think this is a small move, this is quite a significant move. This is already 379 points, or basically that 7.9 pips. So gold can be that volatile. So sometimes when there's a clear price pattern, it may happen very fast and the price is almost hitting that target. So AUD-USD making an impressive rally after bottoming from our area identified support area. So we identified this as a previous high, previous low, and now potential current low. So eventually the market managed to bounce from here. We discussed about this early in the morning with a target at 0.65872. So the market has already hit the target and is now moving higher. So now in trying to identify the new high, potentially we could be using the last high that we saw. And this was identified on Tuesday. So the high of Tuesday was 0.66202. So the market could be headed to this level before making another move. So US equity indices have actually been on a very strong run today. And this is majorly fueled by Google announcing its new AI product, which is rumored to be better than ChatGPT. So after that announcement, we have had quite a strong rally. So you can see the Nasdaq making an impressive rally, beating yesterday's and the previous day's high, and we are almost hitting the week's high. So the highest price we have seen in the Nasdaq this week is around this area. Notice how it's a major resistance here and resistance here. So 16,062 seems to be the nice target here. And if we break that level, then we go for another high, which will be all the way up to around 16,167. So for the US30, it has remained within this range for 4 more days. So in this case, we still be patient and wait for a break, whereas the S&P 500 has rallied to the previous high. This is the high that we saw right here. And now we are almost hitting the weekly high. So the weekly high is still significantly higher than the current price level. So we could be seeing 4,596. So our potential break will get us to this level before we observe this price to see if there's a potential for a break. So for the French 40 index, we speculated that this pullback was very important for a continuation move upwards. So since morning, the market has struggled to catch up with yesterday's high, but then the trend remains quite strong. So there's a good chance we could be seeing the market headed higher and hitting 7,454. So for the Euro 50 index, also struggling to get to the previous high that we saw yesterday, but then still bullish. So in this case, even though the market is struggling, this still remains a target of 4,494. Whereas if you are watching Bitcoin, we had a break earlier in the day. The break did not last long and the market went right back and got back to this upper trend line. So we already have a potential break towards the lower side that already failed and the market got back to the pattern. So now the thesis moves towards the upper trajectory. So in this case, I expect to see a potential break upwards. So in this case, it's a wait and see move where you wait until you see the market breaking that upper trend line. So the UK 100 or the FTSE 100 seemed to be the weakest in the morning, but then in the afternoon hours, it has managed to recover and make a strong rally. So in this case, the potential for the market to retest the previous two highs, and this is around 7,542, seems really reasonable. So in this case, I'm expecting for the market to continue with this journey and eventually get to this price level. So that's it for the day. I'll be looking at your questions, try to answer them as we approach the end of the presentation. Hi, Joseph. I can see Trapscade in the house. What are your expectations of the non-farm payrolls tomorrow? I expect the number to miss expectations, and if it does, then it could accelerate the dollar weakness. So if we get a smaller number than expected, I expect to see some further dollar weakness. Of course, you don't trade before confirmation, so you kindly be patient, wait for the news announcement, and once the news have been announced, then you'll know how to react to the markets. So in this case, a weaker than expected number is expected to be extremely bearish for the dollar, and of course, you know how to trade that against other currencies. So hello, Tony, and thank you for joining the session. Hello, J Squad, and a lot of shots. Why doesn't third world and emerging economies always have low rates like it is in the major economies like Japan, China, US? Is there a particular reason for this? Yes, there's a very good reason for this, and thank you for asking the question. So governments normally do deficit budgets across the world, a majority of them, not all of them. And when they do, they basically borrow money and use that to invest in the economies. So in this case, the US government is in debt, the Eurozone government is in debt, Bank of Japan, and every other bank. So when they borrow money, investors have the option of choosing to invest in one economy over the other. So investors, let's say commercial banks, hedge funds, and every other bond market participant has the option of investing in any government. So they know that they want to invest in the most stable government, so where they are assured of returns. And so far, the strongest economy in the world, the one that is most secure and has the lowest likelihood of defaulting on your bonds, will be the US government. So the US government will basically issue bonds at a certain interest rate, which investors will find attractive and subscribe to those bonds. So for you, if let's say you are running a central bank like the Central Bank of Kenya, you would have to convince an investor not to invest in the US government bond and to come and invest in the Kenya government bond. So in order for that investor to consider your bond, you'd have to offer more attractive yields in order to cover for the significant risk that the Central Bank of Kenya could default on its debts, or the risk that the Kenya shilling could be losing value against the dollar. So in this case, in order to attract investors, you'd have to offer significantly higher yields in order to attract these investors. So what normally happens is that if the US is hiking interest rates like it did in the last 18 months, moving interest rates from 0.1% all the way to 5.50%, this has the full impact of raising yields on US treasuries and making them more attractive to investors. So you find a lot of money flowing from emerging markets as well as from tier markets, as well as other developed nations towards the US treasury bonds. So In that case, if the US is offering a yield of, let's say, 5% on some of its bonds, and your currency is also losing to the dollar, then your central bank would have to offer significantly higher yields in order to at least attract some international capital. So I hope that explains things as is, where emerging economies will have to outmatch the strongest economy in the world in order for them to attract capital, and in that case, issue bonds with higher yields. What happened to DXY today after jobless claims? Will you elaborate? So as I mentioned, from the job market data that came out today, the jobless claims did not have such an impact. 220K versus 221 and 2219 is just as expected. There's no much of a difference here. So the big number is right here on challenger job cuts. So when you see a negative 40.8%, this is a big alarming number. Change in the number of job cuts announced by employers. So if there's more and more job cuts, in this case, it basically means that the US economy is weakening, and a very soft job market means that the Fed has already achieved its goals, and the potential for rate cuts becomes even stronger. So as a result of that, that may explain why we saw a much weaker dollar index happening this afternoon, and it's continuing as we speak right now. So that's it for the day. Thank you very much, guys. Thank you for your time, as well as your participation and questions. I appreciate every one of you, and I hope to see you on the next session. So the CBK has raised rates. If you had dollars hoarded, would you release them? No, I wouldn't. They have not solved the underlying factors that are leading to the weakness in the Kenya shilling. One of the factors is the huge gap in the balance of trade. So we are importing way higher number of goods and services compared to what we are exporting, which means we have a deficit. So we need to spend more shillings to buy more dollars that we use to buy products and services from the rest of the world. So in that case, it basically means that we have an excess of Kenya shillings and a scarcity of the dollar. And as long as this remains the case, then we continue seeing more pressure against the shilling. So at the same time, interest rates in the US are still significantly high, so bond yields are still good. So we don't find this environment where investors tend to flock to emerging economies. So this is not happening yet, and as a result of that, there is a high likelihood that our economy doesn't have the right environment to attract foreign investors, which means that the Kenya shilling may continue to slide against the dollar as well as other currencies. So in this case, I wouldn't raise my dollars just to hold on to Kenya shillings. Kenya shillings are not gaining until something fundamentally changes. So that's it for the day. Thank you, guys. Remember to subscribe to the channel, get notifications on, and of course, listen to the most recent episode of the Bullish Banter podcast for some insights on what's happening in the global macro. And hopefully this will give you some good insights to help you with your trading as well as the understanding of the markets.